Hi, welcome back. This week, we are covering the project analysis and evaluation template. This is due on Sunday night, and then you will be discussing it and what it means. You'll be basically answering each question. So, the memo for this week will be a little different in that I will have you number the items. So, please do number your answers. Scenario one here has 1A through, I believe, J. And then if you're moving on down, you're going to see scenario two, which is 2A through I. So make sure you number each of your answers as you're answering them. If it's one that is supposed to be done only in Excel, for instance, it says calculate the internal rate of return for each alternative. 1D, obviously you're going to skip that. You're not going to put that on your memo unless you want to summarize what the IRR was for each alternative. I'm okay if you don't. The idea here is to get you to see all of the methods that can be used and to use them to make good decisions. So the first scenario here says that we have a company and they are considering two mutually exclusive methods. So alternative one and two of producing a new product. So all of the relevant information is down below, and you're going to use it to come up with the cash flows that you would expect by putting into place this new product, this new production method. I mean, the couple key points here is all net working capital that you borrow from the firm is going to be recouped or returned to the parent firm at the end. The company's tax rate and the discount rate are provided, and the annual depreciation should be calculated using the straight line method, where the initial investment is divided by the expected life of the equipment. And I'm going to go ahead. I just noticed a typo, and that drives me nuts. So I'm just going to. Okay. Um, we are. We are. There are several areas of this that you can probably figure out. The first thing is that you are constructing an annual pro forma forecast. So the first alternative one, oh, do please make sure you put your name in here. It's easier for me to grade when it's right there. Um, so alternative one, you'll see you do have to calculate annual depreciation. And then you need to translate each of the data entry items. Here is alternative one, and then you also need tax and discount rate to be applied into cash flows annually. So for the first project, it is just 4 years. So you can see that I've actually highlighted all of the cells that should have a value in it. Whether it is possible to have a zero value in the first and second alternative, it does say that the product that the useful life of the equipment for alternative one and two is going to mean that the product will be discontinued, and there's no, like, it ends at the 4 years and there's no salvage value. So for both of these alternatives, there will not be an after-tax cash flow. So you can pretty much go ahead and put that zero right in there. That's the only one that does have a zero initially. And then let's walk through this. First of all, when you have an initial investment, that is a cash outflow. So that outflow would be placed here at time zero. This is a timeline across the top. And so at time zero, you would place this equals and then refer to the initial investment. And you actually want to make this equals negative because it's an outflow. When you're doing a cash flow statement and you're going to be using the functions of Excel, it's pretty helpful if you can put your cash flows into inflows and outflows. This helps to make sure that you will appropriately account for them when you're doing time value of money calculations. So the initial investment here is you are paying out $60,000 for the initial investment. Also, you have a net working capital investment. You're going to do the same exact linking, and it is going to be an outflow at time zero. The interesting thing is, whenever you are at a firm and it's deciding about doing new products, it's almost like when you work at a grocery store. If you're working at a grocery store and you have a cash register, there's cash in it in the beginning, right? You have to have cash to make change, to take care of things that people are buying lottery tickets, and so you might have to make change so that you can apply that to the lottery money, or a separate area, or tax money that's collected on the products that you're providing needs to go to the government. Well, whatever things that you're taking care of for the day, somebody has to take money out of the account and put it into the cash register for you to start with. So it's the same thing with a project, whether it's money to buy the supplies for this product, or maybe it's inventory, or maybe it's the resources you need to make it go, or whatever the case may be. That money has to come from somewhere, so you basically borrow it from the firm. So this is the firm outflow, but at the end of the time, you would expect it to come back. Now, when most companies would have a net working capital investment in each time period, I'm just trying to keep it simple. So I've done, basically, there's going to be some investment at the beginning, and that same amount gets recouped by the firm at the end. So the net working capital investment for project one is 5,000. So equals five, the negative cell C18 here. And then when you come to the end of the timeline at year 4, since the equipment and the project are both expected to last just 4 years, makes it easy. So in this case, I would equal C18, but I would keep it positive because it goes back to the firm. So we've handled initial investment, net working capital. And then you're going to need to fill in all of the annual cash flow items. You'll notice that the annual receipts is another term here for revenues. Annual disbursements, those are operating expenses. So you want to make sure that you make those negative as well. You can keep them positive as long as your EBIT formula subtracts them. So I'm okay if you want to do an accounting format for this section and not making things negative and keeping them in the positive accounting, as long as when you get to your statement, like your EBIT, you would take your revenue and then subtract operating expenses and subtract depreciation. So if they're all positive, that's what you would do. If you go ahead and make your operating expenses negative and your depreciation expense negative, then this would equal the sum of revenues plus operating expenses and depreciation expense. Whichever way you like is absolutely fine with me. Just be consistent. So taxes then, taxes are going to equal your EBIT times 1 minus the tax, or I'm sorry, it's going to equal your EBIT times the tax rate. You need to refer to this cell. So if I'm out here, I'm going to say equals, I'm going to refer to the previous cell, times, and I'm going to grab the tax rate cell, and then I'm going to need to freeze this cell. If you are on a regular PC, you can hit the F4 button and it will put the double dollar signs there. The reason I'm freezing the whole thing is because I am going to go end up copying this formula the whole way. Oops, sorry. My mouse has been acting wonky. Sorry about that. The whole way across, as well as my EBIT formula will be across. And most likely you will, when you put your revenues in here, it's going to be the same amount. So you will want to freeze the column and then copy it across for both of them. For instance, equals the revenue is your receipts. And I'm going to freeze the column to be a $C. And that way, if I copy this, it should be referring to the same exact cell each time. Okay. After I input my tax amount, now this could, if you want to, you could keep this in inflows and outflows. And if that's the case, these would be your outflows. Tax would also be an outflow. And then you could just, if you're keeping it on the positive end, you'll just take this minus this. But if you make this a negative, obviously it would be adding the two together. So just be aware of what you're trying to calculate with your financial statements. When you get done with this one and you've input everything, all of your annual cash flows need to be summed up for this after-tax cash flow line, which is basically your annual cash flows for your project. So for the first one here, it's going to equal the sum of the initial investment plus your net working capital. And then this one, the years 1 through whatever n minus 1 is. So if n is the last year, whatever the last year is, this formula won't work for it. But for years 1 through 3, I'm going to go ahead and equal the EBIT after tax value. Oh, no, I'm not. Hmm. Okay, so I I messed that up. So in order to translate my basically net income, if there's no interest, net income into an after-tax cash flow, I need to take my EBIT after tax and add back my depreciation because um, operating cash flow is what we're looking for, and operating cash flow is equivalent to your earnings before interest and tax minus the tax plus depreciation. So that gives us the actual operating cash flow that we need. Now, I do need that for year 4, but in addition to that, I need to add the other 2 terminal cash flows. So when we think about the last year, we need the operating cash flow for the final year, plus we need to add in any after tax cash flow. And then we also need to consider the net working capital recoup of the initial net working capital investment. So once I've added those other 2 pieces, I will end up with a total annual cash flow for after tax cash flow for year 4. You will do the same exact process for alternative 2. The only thing I haven't covered yet is depreciation expense. I'm coming back to that. Years after this, you're going to see this line that says difference to cash flows for the crossover point. You're going to understand what that is for in a minute, but basically you'll be subtracting one cash flow minus the other for each project. So you could take project 1's cash flows. So from time 0, sorry, here's my timeline. I would be taking project 1 cash flows and subtracting project 2 cash flows. So you would put that in your formula where you would come up and create this formula, and then we will be using that in the NPV profile. But that's going to be the last thing. Now that is going to be located over here on the right. Over here, I will walk you through an example to help you understand what you're solving. But you are basically solving for the net present value for each alternative at these specific discount rates. And then you're going to find the crossover point. And I'm going to explain what that means. So I'm going to do an example for you so you'll understand how to fix that. And I've already set up the chart for you. So as you put in a value, it's going to go ahead and input the designated lines for you. Once you put something in there, it should have be completed for you already. Okay, so next, for alternatives 1 and 2 are the net present value, benefit cost ratio, internal rate of return, and equity. I'm sorry, the equivalent annuity benefit. I'm going to go through these in an example as well. That'll be in the next video taping. And scenario 2, I just briefly want to walk through this. This same company is going to consider additional investment opportunities. The big deal is this. These 2 alternatives up here are mutually exclusive. Okay, when you see the words mutually exclusive, it means that you can only choose one of them. It's because whatever resources or property is being used, it can only be used for this or that. It's not an and statement. If they were independent projects, you could choose them all if they're acceptable projects. In this case, these 2 methods for producing a product, you're either going to produce it with alternative 1 or with alternative 2. You don't have to produce it both ways, but you need to make an investment in one of them. So you're looking to choose the best alternative. That's what it's asking you to do in scenario 1. When we get down here to scenario 2, you're going to go ahead and link to whichever mutually exclusive choices. You don't have to actually input the value here. I just want you to be aware that you need to choose from 1 or 2. And then you'll be comparing and ranking it against alternative 3 and 4. And the idea here is that all of these opportunities now are independent of one another. And so by accepting the mutually exclusive choice, you can still accept 3 and 4, or you can accept 3 and 4 and not, or you could do 4 and this one and this one. It doesn't matter which way, because they're independent. So, in other words, each project stands alone as to whether or not you will accept it. There's this principle called the standalone principle, and that's why each of these projects are basically treated as if it's its own company, coming up with the cash flow forecast for the life of the project. You would do this for any kind of an analysis where you only put the costs and revenues in that are associated directly with it. So the standalone principle, you're trying to come up with just the costs and revenues that are directly tied to or come from that project. You will go down through and try to link every single value here, or use it in some way. A couple things are going to be different about these two alternatives. You're going to notice that the life of the project is different from the expected life of the equipment, and that the equipment has a market value at the end of the term. This is different. Up in scenario 1, there was 0 salvage value. Okay, so the other thing is, in scenario 1, it is straight line depreciation. We're doing 2 different things because I want to show you the difference between them. So up here, you would take your value of your initial investment and subtract out salvage value and divide by the number of years of the project in this case. So since they're equivalent. So 60,000 minus 0 divided by 4 is going to tell you the amount of depreciation for each year. And you can do this in a formula. So equals my initial investment, and then I'm going to subtract out any salvage value. I need that in parentheses, and then I'm going to go ahead and divide it by the expected life of the equipment, and I'm going to hit go, but then I need to come back in here and make sure it doesn't change from column C, okay, because I need to copy this across. The column needs to stay exactly the same, and I'm going to have my depreciation, and I'm going to check it. It should add up to 60,000. If you look down on the bottom, it should have a sum. If your Excel spreadsheet does it, it should have a sum of the 4 items. So in doing that, why didn't it do that? There we go, $60,000. Down at the bottom, that's your straight line depreciation. Now at the bottom in scenario 2, we have what's called the modified accelerated cost recovery system. And whenever you're doing these, you actually care about the life of the equipment. Okay, so you are allowed to take the depreciation over a certain number of years, depending on the life of the equipment. And so what I'm doing is I've set up the tables for you. You'll have to calculate the depreciation expense for the first project and for the second project based upon the life of the equipment. And then you also need to come up with the ending book value. And the reason you need to come up with this, it equals the rest of the depreciation beyond the project life. So because the first project actually ends in year 5, the depreciation is scheduled to be expensed over 8 years based on a 7-year useful asset life. There's a half-year convention. Don't worry about it. A 7-year table always has 8. A 10-year table always has 1 more year, so 11. But the idea here is if it's a 5-year project, you will have only expensed the sum of that, which is 77% of the asset initial investment value. You are still allowed to take expense, a deductible expense of 22%. So whatever is remaining after the end of the project, then you can go ahead and calculate it based upon whatever the initial investment was. So take that percentage times the initial, and it'll give you your ending book value. And that's important because when you get to the end of your project, to calculate this after tax salvage cash flow, we need to know what it's going to be worth and then what we're still allowed to take to see if there's a capital gain or a capital loss. If there's a capital gain, we're going to pay taxes on it because that's what the government looks for. If we make money, they want a piece of it. But if we lose money, in other words, if the ending book value is greater than the market value, okay, so we would have a capital loss, we would end up being able to get a credit in our taxes that would apply against whatever the firm is paying in taxes for that year. So we would see here that this would end up being the market value minus whatever that tax cash flow is. So we're gonna learn how to calculate that tax cash flow as well. Okay. Um, I'm gonna in the next video I will go over the depreciation expense for sure. And finally, when you get the fourth project done, you will have all of the alternatives completed with their cash flows. The discounted cash flow valuation will be when you compute your net present value, benefit cost ratio, internal rate of return, and the equivalent annuity benefit. And then you will talk about them next week. So I encourage you to really try to get this done early so that you can start answering these questions and really looking and digging deep into what they mean. I'm going to go ahead and cut this one short, and then I will come back in the next video and walk you through two things, maybe three. So the net present value profile, the NPV profile, as well as how to calculate the four methods for an evaluation. And then I feel like I'm missing something. Oh, how to calculate the modified accelerated cost recovery depreciation amounts. And last, I will cover the after-tax salvage cash flows for those that have an ending book value and a market resale value. Okay. Thanks again.